from precious metals, we see the central bankers doubling down on their efforts, doubling down over the last 2 months of the year, twice what the 12-month moving average is. China and Saudi Arabia doing all they can to covertly, privately, although they've been caught twice now, accumulating gold and listing far less than they're actually buying. In other words, the biggest money in the world, the central bankers who know the playbook, the biggest money in the world who's draining the exchanges off of COMEX and the LBMA, the biggest money in the world that is creating shortages in industrial grade bars, are ahead of the curve, where the retail consumer is again being misdirected largely into areas that you could argue on many levels are overvalued.
In today's news recap, gold prices see some profit taking, but hold the line above 2,700 as housing starts rises 15.8% in December. Gold is facing some selling pressure, but remains above $2,700 an ounce, even as the U.S. housing market shows signs of stabilizing with improved housing construction activity in December. Housing starts jumped nearly 15% last month to a seasonally adjusted annual rate of 1.499 million units, up from November's reading of 1.294 million units, the Commerce Department announced on Friday. The data significantly exceeded expectations, as economists had forecast a slight increase to 1.33 million units. Despite the monthly increase, the report noted that housing activity is still down 4.4% compared to December 2023. Better than expected construction data is adding pressure to gold, which is already experiencing some profit taking after prices hit a 2-month high on Thursday. Spot gold last traded at $2,705.90 an ounce, down 0.32% on the day. Technical analysts will monitor whether the $2,700 level holds as support. This level has acted as solid resistance, with prices consolidating in a narrow range over the past 3 months. Economists are closely monitoring the U.S. housing sector due to its significant impact on GDP. The sector has struggled as consumers have been priced out of the market. Higher interest rates have pushed mortgage rates higher, while low inventories have kept prices elevated. Some economists expect the housing market to continue facing challenges as the Federal Reserve looks to shorten its easing cycle through 2025. Markets are currently pricing in one 25 basis point cut this year. Now, we'll show you the best clips from the latest interview, but first, like, subscribe, and turn on notifications so you don't miss our daily recaps. Also, check out our NordVPN deal. It's the fastest and most reliable VPN on the market. If you're a stacker, this is a perfect fit for you because safeguarding your internet data from government surveillance will be crucial moving forward. For a small cash outlay, you can ensure you're protected from prying eyes. Check the link in the pinned comment and get 3 free months today. Enjoy the episode.
The BRICS, which Andrew, you and I have talked about a lot, we're very close to issuing their unit gold-backed currency over Enbridge, but at the 12th hour, the BIS and Augustus Carstens pulled the plug. The BIS Innovation Hub was helping China, Hong Kong, Thailand, and the UAE develop Enbridge and also to run the unit settlement token, who Dilma Rousseff, the former president of Brazil and the head of the New Development Bank, said we've agreed in principle to this, basically Sergei Glazyev's idea that has now materialized. And at the 12th hour, the BIS says, well, we can't be involved with any country like Russia that's being sanctioned by the West. It's as if they just realized over the last 4 years that Russia was the R in BRICS. And so they've pulled back from this. But in essence, what they are doing, until they get a more cohesive settlement currency and a platform to trade over, I think that they realize that the need for the U.S. Treasury is fleeing, and instead they would use gold as a neutral reserve asset to settle their trade surpluses. So in essence, what you're seeing are these countries who realize the West, whether it be the United States through what he calls, President Trump calls tariffs, they're actually sanctions masquerading as tariffs. You don't say 100% tariff if you don't do this. That's a sanction, and that's a threat. And instead, they're accumulating gold, which has doubled the performance of the 10-year Treasury for the last 25 years, but has no counterparty liability. It's also been reclassified by the BIS as something tier one or high quality liquid asset. And all of these things, you put them all together and it becomes very obvious that these countries have chosen to shed treasuries and to accumulate gold instead of those treasuries. And I think that is a trend that will continue, absolutely. With total vault holdings of about 850 million ounces. So you're talking, and there are people there that are saying they're trading upwards ends of 2.9 billion ounces of silver per day, which is 3.5 times the annual global mine supply. I don't have the exact numbers in gold. I think they're trading roughly 2.5 times annual global mine supply in gold. And I think what changes things now is that the big money across the globe, in particular the Southern Hemisphere, the BRICS, they understand what we're doing and they're using it against us. We saw 55 or 45 million ounces delivered off of COMEX in December. There was an interesting comment by the gentleman who is working with the BRICS grain exchange, and I would draw a parallel to the precious metals exchange. Rob talked about this on Danny's Capital Cosm show about the exchanges in Brazil, in Dubai, in Russia, in Moscow, in Shanghai, and how they will build a BRICS gold exchange, but. Listen to the comment the gentleman said about the grain exchange. He says, we produce more grain and consume more grain than the folks do in the West, yet we can't control the prices. It's controlled on COMEX. But with the development of the grain exchange, that will change. They know what we're doing, and they're not bitching about it, probably even adding to these short positions with paper in order to drain the exchanges slowly and methodically, do the exchange for physical off of other exchanges. Rob talked about that in that interview with Danny. He said, look, they can buy and take stuff off of other exchanges, but it doesn't disrupt the price the way it does when it's taken off COMEX, which is the price setting mechanism. You see China going around the world and buying doré and concentrate. 75% of all their industrial silver is now concentrate. They're buying it directly from the miners, disintermediating the marketplace. And this comes from the second largest producer of silver in the world. I said that to David Morgan. He says, well, they're actually the first. That's what they told me. Well, it doesn't matter. It's semantics, first or second, but yet and now net importers instead of net exporters, flying around the world, buying concentrate and doré directly from the miners, which doesn't affect the price, or it's very opaque as to how much they're getting. And virtually no effect on the price. They're pulling out all of the stops, knowing that we're doing this. And the only reason they're not bitching is because they're the ones that are accumulating it. And that's really the key to all this. We're being played by it, and we're being played by our own stupidity. And, Rob has always talked about the London gold pool, and Craig is the one who's always talked about the London gold pool. But if you go back that far, the LBMA is 140 years old, and the COMEX since 1974, all the way until just maybe a decade ago, all of these countries were third world. They weren't challenging or standing for delivery. Nobody did. But now they're sophisticated, they're coordinated, and they're motivated, and they're doing it just fast enough so that we can see it, public doesn't see it, and they're doing it not too fast to disrupt the apple cart. But I think the key to all of this is seeing the deliveries and the lengths. Look at Saudi Arabia and China hiding how much they're buying, not reporting it to the IMF. If the PBOC buys it, it has to be reported. But if the PLA, the People's Liberation Army, buys it, it doesn't. Remember, they're buying all the doré. If it's not 995 pure, it doesn't have to get reported to the IMF. Look at Saudi Arabia. Oops, sorry, we didn't report it. You got caught on the import-export numbers. All of these countries are doing all they can to exploit the delivery mechanism and buy it around the globe. at these stupid fugazi prices that we continue to portray to support the illusion, the strength of our Western system and of our bond markets. And it is coming to an end. And that's why I named my podcast Little by Little, because it refers to the logarithmic decay, little by little by little by little, and bang, all at once. And where are we in the all at once? Where are we on this chain? They know what we're doing. If they know what we're doing with grain, they know what we're doing with precious metals, and they're using it against us. And it too will change.
In today's news recap, Goldman Sachs now sees $3,000 gold only next year as fewer Fed rate cuts slow 2025 price growth. Gold's record-breaking rally will slow down this year, with the yellow metal taking longer to reach the $3,000 level. But steady central bank demand remains a key long-term price driver, according to a leading investment bank. Goldman Sachs Group Inc. announced on Sunday that it no longer expects the gold price to reach $3,000 per ounce by the end of 2025, with the Federal Reserve's shallower rate cut path pushing the forecast to mid-2026. Goldman analysts, including Lena Thomas and Don Stuyven, wrote in the update that slower monetary easing will likely depress demand for gold-backed exchange-traded funds, ETF, in 2025. They now project the spot price to top out at $2,910 per ounce by the 2025's fourth quarter. The analysts added that weaker than expected ETF flows in December, driven by easing uncertainty after the U.S. election, also resulted in a lower starting point for gold prices into the new year. Opposing forces, lower speculative demand, and structurally higher central bank buying have effectively offset each other, keeping gold prices range-bound over the past few months, the analysts wrote, but added that demand from central banks will remain a key driver for prices over the longer term. Looking ahead, we forecast monthly purchases to average 38 tons through mid-2026. Goldman's economists now expect 75 basis points of interest rate cuts this year, down from their previous prediction of 100 basis points. The updated forecast is still more dovish than current market pricing as the bank sees underlying inflation trending lower. The analysts also said they were doubtful that the incoming Trump administration's policies will necessarily lead to higher interest rates. Now, we'll show you more clips, but first, subscribe and turn on notifications so you do not miss out our daily recaps, and check our NordVPN offer if you're a serious stacker, because keeping your browsing data safe from the government will be crucial moving forward. Also, check goldsilvermerch.com to get your gold and silver gear today. Premium quality shipping worldwide by Stackers for Stackers. Enjoy the episode.
There are larger orders that are being done by more sophisticated investors. And I use the term sophisticated carefully. It's not that they're smarter than the average person. It's just that they're perhaps paying a little bit more attention to their finances and have accumulated a little bit more than the masses. But in general, I would say it's eerily quiet. And it's interesting because we hear all of the issues with tightening on the LBMA or on the COMEX, or 55 million ounces delivered off of COMEX and silver in the month of December. All of these things, anecdotal, that are on the wholesale side, up a few steps above up the ladder, are disconnected from the reality here in the United States retail. And Andrew, I think it's, or Andy, I forgot which one I am right now. Anyways, I would say that a lot of it has to do with the euphoria surrounding, the Trump win, and rightfully so on many levels. We've lived through what is considered bizarro world, and to get our culture back is a big thing. To get normal back in order is a big thing. And of course, he's being touted as the crypto president. And so there's been a lot of, I think you can say, attention moved from precious metals into other areas. And what I find most interesting about this, I've always been a big fan of misdirection. the art of war. It's pervasive. It's used everywhere, especially at the highest levels. And as the public has been misdirected for really almost a year, if we're being honest, into things like Nvidia, Bitcoin, and Apple, and cryptocurrencies in general, XRP, and all of these meme coins that are making people fortunes. And moving away from precious metals, we see the central bankers doubling down on their efforts, doubling down over the last 2 months of the year, twice what the 12-month moving average is. China and Saudi Arabia doing all they can to covertly, privately, although they've been caught twice now, accumulating gold and listing far less than they're actually buying. In other words, the biggest money in the world, the central bankers who know the playbook, the biggest money in the world who's draining the exchanges off of COMEX and the LBMA, the biggest money in the world that is creating shortages in industrial grade bars, are ahead of the curve, where the retail consumer is again being misdirected largely into areas that you could argue on many levels are overvalued and are oversold and or overpurchased, overbought. And I don't know. It's an interesting dichotomy, Andrew, for sure it is. And one that I think if anyone was saying that business in this industry is really brisk, they're not really quite being honest.
What are your thoughts on Andy Schectman's interview? Do you agree with his predictions? Do you think the BRICS nations could challenge the US dollar and disrupt the American economy? Could gold really blow up in 2025? Drop your honest opinions in the comments and let the stacker community know if you're investing in miners or prefer sticking with physical metals. Thanks for watching. Don't forget to check out this video over here. I'm sure you'll enjoy it. I'll see you on the other side.